A big part of our strategy is to add that institutional value add, which generally you will see a lot of larger funds coming in later in the stage, do in this stage, because we believe, again, we call it the last long mile, some people call it the deep valley, where the success rate is the lowest or the rate of failure is highest after seed and then getting to Series A. And this is where we think with our kind of institutional hat and value add, we can be a differentiated fund. And just to go along with the strategy is that we will not do a lot of deals, i.e. We want to be pretty closely involved with the companies that we invest in. So the idea is to invest in, let's say, anywhere south of 20 companies from the fund. So again, we call it the WaterBridge, other than the WaterBridge deep value add, which I spoke about, we call it, technology as the exponential enabler. As long as that underlying enabler is technology, we're fine with it. And as an example, we say, we're fine with pretty sophisticated machine learning based businesses. It could be an agri-services business, as long as technology is what gives the scale and it's part of the moat in the business. One cannot dispute the statistics and the macro numbers that the overall quantum of capital has come down in the VC in asset class. But if you look at the number of deals, it's not significantly down from the so-called 2015 peak. What I'll add is that, again, 2015 is definitely not the norm. You have to filter in 2 or 3 large institutions and a few hedge funds, which is what I call temporary capital that had hit the market. If you filter those numbers out, the rest of the numbers are pretty similar to 2014 or 2013 kind of numbers. So there isn't as much of a crunch if you filter in some of that froth. And I continue to believe that good companies are getting funded even now, and we've seen some very impressive and large $10-15 million Series A rounds. Overall, the gloom and doom effect is there, where there's a bit of a ripple effect where the Series B and C, the number of deals has slowed down. So guys in Series A and earlier stages also have tightened the tap a little bit. Just look at number of new funds that are being launched, especially in the Series A or before kind of stages. That probably gives some sense of that people are able to see that opportunity. And from a supply of companies point of view, we don't see any dearth. We see a lot of good companies, and the one thing that has changed is, of course, quality of the discussions, quality of the deals. That has gone up with this overall crunch in the capital. My advice is, look, focus on the basics. It's good that now everybody is talking about those same metrics. It's okay to look at GTVs or GMVs in your businesses. It's okay to offer discounts and cashbacks, but it has to be, it's a finite game. So you have to see something out of this. Focus alone on gross numbers and not focusing on profitability. That's not going to work. So I guess paths to profitability, your visibility as to how will you get there, unit economics, very close and a tight focus on your burn rate. Some of these things companies will have to do a lot more of, because the environment has become a little bit more sensitive to it. Which is, by the way, the right thing to do anyhow. Or it was the right thing to do 2 years ago, it's the right thing to do now. There's a little bit of a hangover effect still. So you still see a lot of Me Too food tech company or a health tech company that is still getting cleaned out from the system. So that 10th or the 15th online grocery company where there's absolutely no differentiation, and there are 2 or 3 very large, highly funded players. So you absolutely see no, promise for some of these companies. But I think that will take some time to clean up. Besides that, I think fintech is a very interesting space where we're seeing good quality teams with very interesting products and long-term sustainable plans, because we do know that access to finance, whether it's at the B2C level and the B2B in the SME space, is still very patchy. So if we are seeing a lot of interesting products and solutions where people are trying to bridge this gap. So that's one area. Clearly, the second phase after the whole e-commerce boom, if you may, and some of this correction, also is including a lot of companies that what we call e-commerce enablers. So we're seeing some very interesting companies, and some of them are product companies. Most of them are sort of SaaS or enterprise product companies, solving the problem to make these companies themselves, the e-commerce companies, more efficient in what they do and smarter in what they do. That's something we're seeing. And as a third trend, I'd say we're seeing a lot more product plays coming out of India. I mean, from places, of course, Bangalore, but places like Pune and Jaipur and smaller towns where you can see teams at least having the vision of developing global products. I think a lot of companies will die down, and they should, unfortunately. And I say this to entrepreneurs also, even if we don't like something and we see, at least our view is that those companies are not going to scale up. These are great lessons for entrepreneurs. So this is what we tell entrepreneurs all the time. It's okay if it's not working out. You shouldn't be sort of chugging along, and it's probably time to shut down. We even tell some companies to return any capital they have left to their shareholders if that's the right thing to do, because this is not a job creation, at least from a founder's point of view, opportunity. It's about pursuing a passion, and if you're not able to do it and the markets don't get it, then some companies should shut down, and many already are, and as part of the hangover and the cleanup, it will continue to happen at least for the next 6 to 12 months.